FAR.F5.M2.
The equity method gets much easier when you stop treating it like a pile of journal entries and start with one question. How much influence does the investor actually have over the investee?
Exactly, Russell. The equity method generally applies when the investor can exercise significant influence over the investee's operating and financial policies. Ownership of 20% to 50% of the voting common stock creates a presumption of significant influence.
And that word presumption matters. 20% is not a magical accounting light switch.
Right, the percentage is a strong clue, not an absolute rule. The facts can show that significant influence does not exist, even when ownership falls within that range.
So the ownership percentage is like a weather forecast. It tells you what is likely, but you still look outside before deciding whether it's raining.
That works. The exam may give you a percentage below 20% or between 20 and 50%, and then provide facts that change the conclusion. The equity method may be inappropriate when the investee is in bankruptcy, the investment is temporary, or a serious lawsuit exists between the investor and investee. It may also be inappropriate when the investor surrendered important rights through a standstill agreement. Another ownership group controls the investee without regard to the investor. The investor cannot obtain necessary financial information, or the investor cannot obtain board representation.
In other words, owning part of the company does not create influence if management treats you like someone standing outside with their face pressed against the glass.
Exactly. The real issue is whether the investor can participate in policy decisions. And remember the broader map. Below significant influence, fair value accounting is generally more likely. With significant influence, the equity method is generally used. With control, usually more than 50% ownership, consolidation becomes the main issue.
So the equity method lives in the middle. You are not just watching the investment's market price, but you also do not control the whole company.
That middle ground idea drives the accounting. The investment is initially recorded at cost. After that, the investment account changes as the investee earns income, pays dividends, and uses assets connected to purchase price differences.
Here is the most useful passkey in the module. Treat the investment account like a bank account. Beginning balance plus your share of the investee's earnings minus dividends received equals the ending balance.
That is the core roll forward. Earnings increase the investment account because the investee created additional net assets. Dividends decrease the investment account because the investee distributed some of those net assets to the investor.
This is where candidates often record dividend income and accidentally count the same economic income twice.
Correct. Under the equity method, the investor recognizes its share of the investee's income when the investee earns it. When cash is later received as a normal dividend, the investor reduces the investment account rather than recognizing dividend income.
It's like a partner crediting money to my account and then sending me part of that balance later. The cash transfer does not create a second profit.
That is exactly the logic. The dividend moves value from the investment account into cash.
Let's use a simple example. An investor purchases 40% of an investee for $330,000. The investee earns $90,000 and pays $40,000 in dividends.
The investor recognizes $36,000 of equity method income, which is 40% of $90,000. That increases the investment account. The investor receives $16,000 of dividends, which is 40% of $40,000. That decreases the investment account. The ending balance is $350,000, beginning cost of $330,000, plus $36,000 of income, minus $16,000 of dividends.
And keep the income statement and balance sheet separate in your mind. $36,000 is the current period income effect. $350,000 is the ending investment balance.
Exactly. They are related, but they are not the same number. If the investee reports losses, the investor recognizes its share of those losses and reduces the investment account. Continuing losses can reduce the investment account to zero.
So the bank account analogy still works. Earnings are deposits. Dividends and losses are withdrawals.
Yes. Now let's add one complication involving preferred stock. If the investee has common and preferred stock, significant influence is generally evaluated using voting common stock. When calculating the income available to common shareholders, preferred dividends must be considered. Cumulative preferred dividends reduce income available to common shareholders even if they have not been declared.
The preferred shareholders are first in line. Common shareholders cannot pretend that claim does not exist just because no check has been written yet.
Correct. Now we reach the more difficult part of the module. The purchase price may differ from the investor's share of the investee's book value.
And that excess cannot be thrown into one giant mystery bucket labeled premium.
Right. The difference must be analyzed. First, compare the investor's share of the fair value of the investee's identifiable net assets with the investor's share of their book value. That difference is an asset fair value adjustment. Then compare the purchase price with the investor's share of the fair value of those identifiable net assets. Any remaining excess is equity method goodwill.
I picture 3 layers. The bottom layer is the investor's share of book value. The next layer brings identifiable assets and liabilities to fair value. Anything paid above that becomes goodwill.
That is a strong mental model. Just remember that the fair value layer must be tied to specific identifiable assets or liabilities. Goodwill is the leftover excess after those identifiable differences are assigned.
And the type of asset matters because some fair value differences get consumed over time.
Exactly. If the excess fair value relates to depreciable equipment or another asset with a limited useful life, the investor records additional depreciation or amortization over the asset's remaining life. That additional expense reduces equity in investee income and reduces the investment account. If the difference relates to land, it is not amortized, because land is not depreciated.
So the premium attached to a wasting asset gets used up. The premium attached to land just sits there unless something else happens.
Correct. The listener should always ask what caused the fair value difference. Suppose an investor pays $300,000 for 40% of an investee. The investor's share of the investee's book value net assets is $220,000. Its share of the fair value of identifiable net assets is $240,000.
That means $20,000 of the purchase price difference relates to identifiable fair value adjustments.
Yes, the investor paid $300,000, but its share of identifiable net assets at fair value is only $240,000. The remaining $60,000 is goodwill. So the purchase price consists of $220,000 of book value, $20,000 of identifiable fair value adjustment, and $60,000 of goodwill.
Now assume the $20,000 fair value adjustment relates to equipment with a 10-year remaining life.
The investor records $2,000 of additional depreciation each year. If the investor's share of the investee's reported income is $36,000, the investor reports only $34,000 of equity method income after the additional $2,000 depreciation.
And the investment account also drops by that $2,000.
Correct. The expanded roll forward becomes beginning balance, plus the investor's share of earnings, minus dividends, and minus amortization or depreciation of excess fair value differences.
What happens to the $60,000 of goodwill?
Equity method goodwill is not amortized. It is also not separated from the investment and tested independently for impairment. Instead, the entire equity method investment, including the embedded goodwill, is evaluated for impairment.
That distinction matters. Do not say goodwill can never be impaired. Say it is not tested as a separate asset.
Exactly. An impairment loss is recognized when the fair value of the investment falls below its carrying amount, and the decline is considered other than temporary. The investment is written down to fair value, and the loss is recognized in income.
And if fair value later rebounds, accounting does not simply reverse the loss.
Correct. A later increase in fair value does not reverse the previously recognized impairment loss.
That rule feels harsh, which is useful for remembering it. The write-down can happen, but the automatic write-back cannot.
Now compare the equity method with fair value accounting. Under fair value accounting, the investment is reported at fair value, and unrealized gains and losses are recognized under the applicable classification. Normal dividends are generally recognized as dividend income. Under the equity method, the investor recognizes its share of the investee's earnings. Normal dividends reduce the investment account, Excess fair value adjustments may create additional depreciation or amortization. An equity method goodwill is not amortized.
So, fair value accounting asks, what is this investment worth now? The equity method asks, what has happened to my share of the investee's underlying net assets?
That is the cleanest comparison in the module.
Now suppose the investor begins without significant influence and later buys enough shares to obtain it.
The investor transitions to the equity method prospectively. The cost of the additional interest is added to the carrying amount of the previously held investment. Retroactive adjustments are not required.
So, we do not rewrite prior years and pretend the investor had influence before it actually did.
Correct. The change begins when significant influence is obtained. For an equity security without a readily determinable fair value, the investment must be remeasured immediately before the transition. Any resulting gain or loss is recognized in income. The outline also emphasizes that when an investment was previously classified as available for sale, accumulated holding gains or losses in other comprehensive income are recognized in earnings at transition.
Think of the transition as changing accounting lanes. You deal with the old measurement immediately before the change, add the new investment, and then follow the equity method going forward.
Exactly. Let's finish with the mental map. First, determine whether significant influence exists. 20% to 50% of voting common stock creates a presumption, but the facts can overcome it. Second, record the investment initially at cost. Third, roll the investment forward by adding the investor's share of earnings and subtracting dividends.
Fourth, analyze any purchase price excess. Separate identifiable fair value differences from goodwill. Fifth, depreciate or amortize qualifying fair value adjustments, but do not amortize land adjustments or equity method goodwill.
Sixth, remember that the entire investment is evaluated for impairment, and a recognized impairment loss is not later reversed merely because fair value recovers. Finally, when significant influence is obtained later, apply the equity method prospectively.
The module is really one ownership story. The investment rises when the investee earns money, falls when the investee distributes value, and is adjusted when the investor paid more than its share of book value.
And the method applies because the investor has enough influence that the investee's performance belongs in the investor's accounting story.
Once you see that story, the entries stop looking random.
Exactly, Russell. Significant influence tells you when to use the method, and the investment roll forward tells you how the entire module fits together.